The Federal Reserve, which is the body that regulates the market, recently released their biannual financial stability report. It noted that stablecoins are subject to runs on money market funds and illiquid assets. These events triggered a downfall in the price of these crypto assets. While this may not be an immediate threat to a stablecoin, the news should be a red flag for investors concerned about their safety. Despite the market volatility, stablecoins remain the holy grail of the crypto world. These crypto assets have emerged as a way to bridge the gap between traditional finance and the world of blockchains and programmable money. As a result, they are the holy grail of cryptocurrency investors. This is due to their ability to bring the worlds of digital currencies together, and have made them the preferred medium of exchange. While the price of Bitcoin and the other major cryptocurrencies have fluctuated and soared, stablecoins have been relatively stable. 3 of the top 4 stablecoins by market cap are not affected by the troubles afflicting Terra USD. While this is not a cause for concern, the broader crypto market has been hit as the traditional financial markets have fallen. Bitcoin fell below $30,000 in early Tuesday trading, and a drop in the stablecoin price may have negatively impacted other risky assets. While the stablecoin market has a long way to go, it is worth noting that the market cap of stablecoins is relatively small compared to those of the largest cryptocurrencies. Bitcoin alone has a market cap of more than $560 billion, while Ethereum is close behind. An algorithmic stablecoin, Terra USD, recently lost its peg to the dollar in May 2022. In addition to this, Terra USD was not backed by cash and its price spiraled downward. In other words, without a backing of cash, it was vulnerable to a run. A private currency is one that has no central bank. While the US dollar is a widely accepted currency, many adherents of cryptocurrencies believe that the future belongs to digital tender. Stablecoins promise to maintain a consistent value, which is appealing for those seeking financial stability. However, most crypto assets have too much volatility to be of widespread use. There are 3 types of stablecoins. Stablecoins are backed by secondary tokens. They are used to conduct international transactions and remit payments. They are less volatile than other forms of crypto, but the risk of a hacker's attack or user error is a real concern. There is also a lot of regulatory uncertainty associated with stablecoins, and the Biden administration has called for additional government oversight in November 2021. Another popular type of stablecoin is governed by algorithms and does not have any collateral. It follows the same storage shares model, which reduces the circulating supply of a particular cryptocurrency. In this case, a stablecoin's price is driven by the supply and demand of the underlying cryptocurrency. This type of private money can help avoid disagreements between cryptocurrency traders. This is important for many reasons. Stablecoins can be used in everyday transactions because the prices do not fluctuate. They are a safe alternative to cash in countries with monetary instability or hyperinflation. A stablecoin is a good alternative to cash in countries where the central bank has no control over the money supply. You can make payments anywhere in the world by using a stablecoin. It is a good idea to keep a safe supply of these coins in your wallet. One of the biggest drawbacks of cryptocurrencies is volatility. However, stablecoins are designed to be less volatile than cryptocurrencies. They are often pegged to a particular asset, such as the US dollar or other national currency. In other words, one stablecoin is one unit of the underlying asset. This ensures that its price will not fluctuate and will remain stable over the long run. Stablecoins are digital currencies backed by an asset, usually bank deposits or US government bills, and are redeemable at face value. Issuers typically hold the reserves at a regulated entity, like a bank. Such a company may have higher levels of transparency and compliance, such as clear documentation of redemption rights and full segregation from other corporate assets. This increases their cost, but is a worthwhile trade-off for the stability they bring. The issue of regulatory oversight of stablecoins is a complex one. The regulatory frameworks currently in place focus on certain segments of the financial system, such as banks. This is why it is crucial that regulators focus on systemically important segments of the financial system before approving new technologies. However, there is still a need for more detailed regulation of these new financial instruments. This is especially important because the adoption of stablecoins could create new risks and benefits for both financial institutions and consumers. The first concern is security. It is essential that stablecoins have full reserves of cash to ensure their value remains stable. If the issuer fails to hold the full reserves, then they risk losing the stability of the currency. Furthermore, unstable coins are susceptible to hacking. To prevent such problems, stablecoin issuers should ensure that the bank holding the reserves is doing the right things and that it is not putting any of its reserves into trading. Lastly, the use of stablecoins should not be confused with private sector digital assets. It should be noted that central banks need to introduce the CBDC model in a timely manner in order to gain widespread adoption. Introducing a CBDC model of decentralized financial services will be difficult. Existing electronic payment systems are expensive and inefficient to implement at scale. Furthermore, emerging privately issued stablecoin alternatives may raise privacy concerns. As a result, regulators should keep an eye on the rapid development of the crypto industry. The introduction of stablecoins in emerging markets may increase the amount of unregulated digital assets and potentially destabilize the economy. For example, some countries have restricted access to crypto assets, and this could lead to a significant increase in volatility and instability. Because of this, policymakers should introduce global standards and enhance their monitoring of the crypto ecosystem. While the role of stablecoins is not yet clear, the future direction of crypto assets will be determined. There is a huge regulatory gap surrounding stablecoins, contributing to a lack of investor protection and fraudulent activities. There are no regulatory requirements regarding how reserves must be invested, or any other standards governing the process. This lack of clarity creates confusion when new products are launched. A recent survey of central banks revealed that 2/3 of them are investigating the potential impact of stablecoins on the financial system. When the price of a borrowed asset goes up too fast, the collateral will automatically be swapped for BOO and the loan will be paid until the value of the assets has risen above $1. This collateral reduces the total amount of BOO needed to pay back the protocol, but it doesn't change the USD value of the assets. Stablecoins take on more liquidation risk than cryptocurrencies, but they are still more secure than the average cryptocurrency. While all stablecoins promise price stability, not all of them can achieve this. Stablecoins fall into two broad categories, non-custodial and custodial. Each of these categories has subcategories. In this report, the authors describe the risks associated with the different functions of these cryptocurrencies. The authors also discuss the implications for the financial stability of stablecoins. As the market for stablecoins grows, regulators need to develop and implement appropriate regulatory frameworks. One key issue is the establishment of global standards-setting bodies. These bodies must analyze existing standards and fill in any gaps. The global reach of stablecoins highlights the need for global standard-setting bodies. This is a crucial step in the process of preventing the proliferation of unstable coins. The international coordination of regulatory efforts for stablecoins is a major challenge. These efforts should take into account diverse economies, jurisdictions, legal systems, and levels of economic development. Regulatory efforts must also consider data use. Harmonization of legal and regulatory frameworks should contribute to more stability for stablecoins. But how do these regulators go about this? Listed below are some challenges and best practices related to global regulation.